Hello, this is Mike with the NetPicks Options Academy. In this installment of our Trade of the Week, I want to take a look at Netflix. Over the last few weeks, we've seen close to a 30% rally in the price of Netflix stock, which anytime you start to talk about that magnitude of a move in such a short amount of time, it's pretty phenomenal. Doesn't matter what the symbol is. Now, much of that move was due to earnings out early last week, but regardless of what caused the move, we need to take a look at this and see if it gives us an opportunity to participate going forward. Now, over the last few weeks, because of the movement, it's been the most popular stock in the market, in my opinion. Whether you're a day trader or a swing trader, a lot of people are trading this product right now. And the problem I have with that, and looking at some of the trades that people are taking, in my opinion, people are taking those the complete wrong way. Right? So if you take a look at any type of financial media, CNBC, Bloomberg, you take a look at Twitter or Facebook, a lot of people are talking about Netflix. And if you take a look at some of the trades and some of the opinions on Netflix, it can be a little concerning. All right, I just pulled up Twitter here. If you just do a simple search for Netflix, you're going to take a look at all of these tweets down over the last week or so. A lot of people are posting trade ideas and what they think might be coming next on Netflix. And I'm seeing a lot of people short the stock. I'm seeing a lot of people buy put options or a put spread, expecting Netflix to move to the downside. And a lot of these opinions are just based on the fact that Netflix has gone so far so quickly. And a lot of people are saying, hey, it can't possibly move any higher from here. It has to move lower. Well, the problem I have with that line of thinking, no one knows what's coming next. And stocks can stay overbought or oversold longer than any of us anticipate. So if you're just going to go out and short the stock or buy a put option, you can only make money in one direction. One way of making money, and that's if it makes a move to the downside quickly. Well, what if it moves sideways? What if it consolidates? What if it continues to move to the upside? You're going to be stuck. If all you did is buy a put option or short the stock, you're going to be stuck losing money in both of those situations. So what I want to do is take a look at a different way of playing this, where it just gives us more ways of making money. It's a more forgiving trade. So let's walk through this in a little more detail. Let's start out with a chart of Netflix. Just so you can see this visually, just in case you have not been looking at Netflix, or if it's not a stock on your radar, this is just a very simple daily chart of Netflix. I don't have a single indicator on this chart. I just want to look purely at price action. The reason I do this, I need to form an opinion on what I think Netflix is going to do. So looking at price action, I would agree with a lot of other traders out there that it is overextended. It is overbought in the near term. But like I just mentioned a few moments ago, that does not mean it has to move lower immediately. It could move sideways. It could continue to grind to the upside. It could continue to grind lower here. No one knows. So what I want to do is, my opinion based on this chart pattern, I want to put on a position that's neutral to slightly bearish. Right? Because I'm expecting this stock to either consolidate or pull back slightly. Now, that does not mean I just immediately go in and buy a put option like so many other people are doing. Because like I said, if you buy a put option, the only way you make money is if that stock moves lower quickly. If it doesn't, you're going to be stuck. Right? So instead of putting on just a long put, I'm going to take a look at selling a call spread. I know a lot of times when you start to hear about call options, you think, hey, that's a bullish position. It is true if you're buying that call or buying that call spread. In this case, we're selling a call spread to open up the position, which is actually going to be a bearish position. So let's go over to the trade page here. Let's take a look at this in more detail. All right, so on the trade page, we have all of the different expiration cycles here. These numbers in parentheses, those represent how many days are left until expiration. I want to take a look at some very short-term options because I'm expecting Netflix to either consolidate or pull back in the very near term. You go out 6 months from now, I have no idea. I have no opinion. I mean, no one knows going out that far. So I'm looking for a very short-term position here. Now, I'm not going to take a look at the weekly options with 2 days left. That's just not enough time. Right? There's just not enough premium there. So I'm going to go out an additional week. I'm going to take a look at these weekly options that have 9 days left. So I mentioned I want to sell a call spread here. So ideally, what I want to do is sell some junky out of the money call options that have a very low probability of closing in the money. So what I'm going to do here is I'm going to take a look. The way I have my trade page structured, all of these columns here at the top on the trade page, you can customize any of these columns. So if you don't see the volume column on your page or the probability OTM, you can add any of these to your page. The one that I'm going to highlight here initially is this probability OTM, which stands for probability of that option closing out of the money. So basically, looking at the pricing model of an option, we're able to come up with some of the statistics that are shown here. What I want to take a look at, I want to take a look at those call options that have between a 65 and a 70% chance of closing out of the money. So I've got this 130 call option. Okay, right now it's got a 68% chance of closing out of the money. So that meets my criteria. What I want to do is right click on this. I'm going to go to sell and I'm going to go to vertical. Down at the bottom, Thinkorswim automatically pops up a spread down there for me, and it has me selling the 130 call and I'm buying the 131 call at the same time. The reason I want to put on a spread, if I just sell a naked call, if all I do is sell that call option, it comes with tremendous amounts of risk. I don't like that risk. I want to be a little bit more conservative. I want to be in a risk-defined trade. So I'm also going to go out and I'm going to buy an option even further out of the money to make sure that I am in that risk-defined trade. Now, it by default pops up a 130, 131 call spread. What I want to do is adjust one of these strike prices slightly. Instead of buying the 131 call, I want to switch that to the 132 call. Reason being, I want to stretch those strikes out a little bit because I want to collect more premium. I want to collect more money up front. My criteria typically states that if I want to sell the 130 call, I'm going to go ahead and buy an option that's a couple strikes farther out of the money to make sure that it's risk defined. So that's why I went out 2 strikes. I went out and bought the 132 call. Right? So when we take a look at this trade, I'm collecting 50 cents up front. So if I hit confirm and send once, we'll take a look at the order confirmation box and you'll see when I clicked on confirm and send, it was actually trading for 51 cents. So I'm collecting $51 per spread to put this trade on. So anytime that you sell a spread, you're collecting that premium up front, which can be very different than what most newer options traders are used to. If you take a look, I'm also risking 149. That's my maximum loss. So you take a look at that ratio and you're saying, well, you're risking 3 to make 1. That doesn't really make sense. In fact, that's backwards of what I was taught. The reason I'm willing to take this trade with a bad reward to risk ratio is all of the different ways I have of making money. Remember what I said about buying the put option. The only way we make money on that is if Netflix moves lower quickly. Well, on this trade here, look at where my break-even point's at. It's at 130.51. And that's just calculated by taking my short strike, which is 130, and I'm adding on whatever I collect to put that trade on. Well, we mentioned we're collecting 51 cents. So now on this trade, I don't care if Netflix moves lower, sideways, or slightly higher. As long as it closes below 130.51, I make money. So now instead of just jumping in with both feet and saying, hey, I'm 100% bearish, I want to buy a put option, I want to go for the home run trade, now I'm put in on a position where ideally I want this thing to either move sideways or lower, but if it continues to move a little bit higher on me, I still have a little bit of wiggle room here. Netflix is currently trading for right around 127. Okay, so I have over $3 on the upside. If it continues to move up by over $3 over the next 9 days, I can still make money. That's the powerful part about this trade. It's forgiving. There's a lot of ways of making money. So we make money if it moves slightly higher, if it moves sideways or lower. That's 3 ways of making money there. We also have an additional 2 ways of making money. We all know that when we buy an option, that option loses some value every day, right? There's time decay there. It's just much like an insurance policy. Every day that we hold that insurance policy, we're paying to do so, right? So instead of buying that option in this case, where we're paying that time premium every day, we're actually collecting that time premium when we sell the call spread. So we're getting paid every day that we hold this position. So that's the 4th way we have of making money. The 5th way is if volatility decreases. Typically, volatility rises when there's a lot of uncertainty. Well, a lot of the uncertainty has come out of the stock because the earnings have been released. Those were out last week. So with the uncertainty gone, I'm expecting volatility to either move sideways or continue to decrease. That's also going to help my position. So I have 5 different ways of making money. All right, the other great part about this trade, look at what I'm tying up to put on this trade one time. $149 per spread. So this is not a trade that you need $10,000 to put on. Right? You don't need $1,500 to put it on. If you put it on one time, you're tying up less than $150 of capital. Pretty reasonable regardless of your account size. So in collecting $51, that's the most money I can make on the trade. And that's, in my opinion, that's why a lot of people shy away from these. You're talking about $51 of profit, which doesn't sound like a ton, right? You're not getting that home run potential where, people buy those options oftentimes looking for the 500% winners. You're not going to get that with a short call spread like this. The most I can make on this trade is $51. Now remember, we're only tying up $150 per spread, so you can put this on multiple times and still have only a few $100s at risk. So you start to put it on multiple times. Let's say you put it on 5 times. Well, sure, $250 doesn't sound too bad, right? For 9 days worth of work, I'll take that. That's a nice little boost to my income. And if you've got a larger account size, you can definitely put this on 20, 30, 40 times. It's not a problem. Netflix is a pretty liquid product, and you shouldn't have any difficulty getting filled on it. So let's go ahead and take that 130.51 break-even point. Let's go back over to that chart here quickly, just to get a visual here. Let's go ahead and draw a line on the chart. And let's put it at, well, it doesn't need to be to the penny, as long as it's close. Okay, so that's my break-even point right there. That was that horizontal red line. The nice part about this trade, doesn't need to be overly complex, right? I'm not using Fibonacci levels. I'm not using different indicators trying to identify targets and stops. All I want Netflix to do is to close below that red line. As long as it does, I don't care where it goes. If it closes below that line by 1 penny, I can still make money on that trade. That's the powerful part about using options to your advantage. Right? Don't just get stuck trading long calls, long puts. Sure, it's fun at times. It's exciting to place those bets and see the large winners when they do happen. But remember, we don't have to be ultra aggressive all the time. We can be more conservative. We can give ourselves more ways of making money. And by taking this call spread, this short call spread, remember, I'm giving myself 5 different ways of making money compared to one way of making money when buying the put option. Well, for me, as a conservative trader, I like those odds. I like the different ways that I have of making money there. All right, so if you're new to options, if you're starting to, take a look at how these products trade and you're saying, well, this still doesn't really make sense to me, feel free to send me an email, mike@netpicks.com. I'd be more than willing to explain this in more detail. But this is a trade that I really like. I will definitely get this one on myself, and then we'll take a look 9 days from now to see, can we go ahead and close this trade out and book a profit. All right, so I'll continue to track this one for us and let you know how it turns out here in our next video. So again, my email is mike@netpicks.com. Feel free to send me an email with any questions you have on this trade. So hopefully that piqued your interest. Enjoy your afternoon, everybody, and we'll be back here next week.